In today's video, we'll be talking about the top 10 dividend ETFs. These ETFs have historically outperformed the S&P 500, making them an attractive option for investors who don't want to take the risk of investing in individual stocks. To create the list, let's use 4 criteria. The ETFs must have a dividend yield of 2% or more, and I ranked them based on their highest dividend yield, year-to-date, 3-year, and 5-year total performance. The total performance takes into account all expenses and assumes that dividends are reinvested. First, we'll discuss the tax implications of investing in dividend ETFs. And second, we'll explore a concept called the dividend trap with a real-life example. Many of you may already have this trap in your portfolio, so it's essential to understand it. Now, let's talk about dividend traps. These are stocks or ETFs that offer a high dividend yield to attract investors, but they end up losing money despite the high dividends. Some people get tempted by the promise of passive income and buy into these stocks or ETFs with expectations of getting rich, especially when the dividend yields are as high as 16%. However, it's crucial to look at the total performance of these investments. Total performance includes both the dividends and the expenses. One example is the Global X Super Dividend ETF, which pays a dividend of 11.8% monthly, sounding appealing. But when you check the total performance over the past 5 years, it's at a negative 9.9%. This means that even with the dividends, the ETF has lost money over that period. If you had invested $10,000 in SDIV in 2018, you would have bought 159.4 shares at around $62 each. Today, the ETF trades at $21, and your 159.4 shares are now worth only $3,368. Despite the high dividend yield, this ETF has been a poor performer, and its market value has declined significantly. In my opinion, this ETF is like an ugly pig with lipstick on it. No matter how much lipstick you put on a pig, it's still a pig. SDIV is made up of poorly performing companies that are just trying to attract investors with high dividends. However, it's more like a reverse mortgage than a growth ETF. You may get monthly payments, but your investment's value will be decreasing over time until it's almost worthless. The first one is the Franklin FTSE Taiwan ETF, which tracks large and mid-sized companies in Taiwan, with a significant focus on technology. Taiwan Semiconductor, a major player in the semiconductor market, makes up 20% of this ETF's holdings. It has performed well, with gains of 15.3% year-to-date and 15.65% over 3 years. The dividend yield is 2.78%, and the expense ratio is 0.19%. However, being Taiwan-focused brings added risk due to tensions with China. Next up is the Cambria Shareholder Yield ETF, which focuses on cash distributions from 100 US companies with high dividends and stock buybacks, while also considering low financial leverage. Its holdings span finance, energy, retail, and process industries, providing some diversity. Its year-to-date performance is below -1%, but it has a strong 3-year performance at 26.15%. The dividend yield is 3.02%, with a quarterly payout. The expense ratio is 0.59%. It's important to note that dividend yields change with the stock price. If the price goes up, the yield goes down, and vice versa. So, don't be surprised if you see fluctuations in the dividend yield. Both ETFs have their strengths and weaknesses, and it's crucial to consider your investment goals and risk tolerance before choosing either one. If you have experience with these ETFs or any thoughts about their performance, feel free to share your thoughts in the comments below. Let's talk about the third ETF today, the Pacer US Cash Cows 100 ETF. Their strategy is pretty simple. They focus on the top 100 companies with the best free cash flow yield, which indicates a healthy company that's likely to offer good dividends and stock buybacks. The sector holdings are not heavily concentrated in energy and health technology. Year to date, it's down by 2.82%, but it has an impressive 3-year performance of over 24% and a 5-year performance of just over 11%, outperforming the S&P 500. The expense ratio is about average at 0.49%, and the dividend yield is 2.12%, paid out quarterly. This CTF appeals to me because it includes fossil fuel companies that pay strong dividends, and as we've seen in recent years, the cost of these resources tends to increase over time. If you are looking for stable companies with good cash flow and dividend potential, this CTF might be worth considering. However, keep in mind that it also carries some risk, especially in the fossil fuel sector, which can be influenced by various economic and environmental factors. So, as always, do your research and assess your risk tolerance before making any investment decisions. Now, let's take a look at the fourth ETF on the list, the Pacer Industrial Real Estate ETF. It's the only real estate ETF I included because of its strong performance in the Matrix rankings. This ETF's objective is to invest in industrial real estate investment trusts that are part of e-commerce distribution and logistics networks, along with some self-storage facilities. I really like that it focuses on e-commerce and logistics, two sectors that are expected to grow significantly in the next decade. That's one of the main reasons why this REIT made it to the top ranks. In terms of performance, it's doing well with a year-to-date return of over 7%, a 3-year return of over 11%, and a 5-year return just above 10%. The expense ratio is slightly higher at 0.55%, and it pays a quarterly dividend with a yield of 2.53%. This ETF adds diversity to your portfolio as it's the only REIT ETF on my list. Now let's talk about the fifth dividend ETF, the SPDR, S&P 500 Fossil Fuel Reserves Free ETF. It's a unique ETF because its strategy is the opposite of some of the previous ones we discussed. It focuses on companies that have no reliance on fossil fuel reserves like oil and natural gas. The name might sound impressive, but when you look at the top holdings, it's mostly the same top tech companies you find in many other ETFs. The top 4 holdings are Apple, Microsoft, Amazon, and Nvidia. This ETF has performed well, with a year-to-date return of 10.5%, a 3-year return of over 12%, and a 5-year return of over 10%. The expense ratio is one of the lowest at 0.2%, and it pays a quarterly dividend with a yield of 2.66%. Overall, it's a solid ETF that has performed well for the past 10 years, with companies that are set to do extremely well in the AI field for the next several years. Now let's talk about the sixth dividend ETF, the iShares US Consumer Staples ETF. This ETF focuses on domestic manufacturers of consumer goods but excludes consumer services. The top holdings include some well-known brand names, many of which are backed by Warren Buffett. The year-to-date return for this ETF is down over 3%, but it has performed well with a 3-year return of over 20% and the best 5-year return of all the ETFs we've discussed, at over 13%. One thing that makes this ETF unique is its focus on consumer staples, which are essential products that people buy regularly, like food, beverages, and household products. I personally like this ETF because I have experience working with many of the companies in it during my time at Target and Amazon. They are well managed with strong leadership teams, which gives me confidence in their financial performance. Even though it's not heavily focused on the technology sector, this CTF has a solid performance and is a welcome addition to my portfolio. Now let's talk about the Schwab US Dividend Equity ETF. This is one of the most popular dividend ETFs, and it focuses on investing in well-established companies with strong dividend yields and a history of increasing their dividends over time. The top holdings of this ETF come from various sectors, and they include many familiar and well-known companies. However, the year-to-date performance for this ETF is the worst among the ones we've discussed, with a negative 7.5% return. On the bright side, the 3-year and 5-year returns are respectable and beat the S&P 500. One great thing about this ETF is that it has the lowest expense ratio of all the ETFs we've talked about, at just 0.06%. Additionally, it offers the highest dividend yield of 3.74%, which is paid out quarterly. While many people consider this ETF to be one of the best, I believe some of the previous ETFs I discussed have shown more consistent performance over the year-to-date, 3-year, and 5-year periods. This serves as a good reminder to always do your own research and due diligence when choosing investments. Now, let's discuss the WisdomTree US Quality Dividend Growth Fund. This CTF includes some familiar large-cap companies with a proven track record. In terms of performance, it has done well so far this year with a return of over 4%. Over the past 3 years, it has seen growth of 15%, and in the past 5 years, it has achieved a return of just over 10%. The expense ratio for this ETF is a respectable 0.28%, and it offers a dividend yield of 2.04%. The unique feature of this ETF is that it pays out dividends monthly, which might be appealing to some investors. One thing that stands out about this ETF is that it holds nearly 300 companies in its portfolio, providing a level of stability and reducing the need for frequent rebalancing. Overall, this ETF is quite similar to the others we've discussed, but its monthly dividend payout option sets it apart if that's something you value. Next up is the First Trust Rising Dividend Achievers ETF. This ETF invests in top companies that have a history of increasing their dividends and aims to continue raising them in the future. It includes a mix of small, medium, and large cap assets across 51 companies, with a focus on technology, finance, and energy sectors. In terms of performance, it has done reasonably well with a year-to-date return of 1.67%. Over the past 3 years, it has seen significant growth of over 17%, and in the past 5 years, it has achieved a solid return of well over 9%. The expense ratio for this ETF is fair to high at 0.5%, and it offers a quarterly dividend yield of 2.32%. Finally, we have the First Trust Nasdaq Technology Dividend Index Fund, which focuses on investing in top technology companies that offer dividends. It has performed well this year, with a year-to-date return of 15.9%, the highest among the group. Over the past 3 years, it achieved a growth of just above 12%, and in the past 5 years, it's been above 10%. The expense ratio for this ETF is 0.5%, and it provides a dividend yield of 2.2%. Please remember that total returns consider both dividends and expenses. Despite the limited history of these ETFs, given their holdings in top tech companies driving AI growth, they might be worth considering for your portfolio.